What's happening, investors? AK here. And yeah, today I'm using slides because we're mostly going over charts anyway, so try not to miss my pretty face too much. But with all this market volatility, everyone's real worried about what's happening. Is a crash coming or are we safe? So that's what I'm going to be going over with you today. And the short answer is that yeah, there's a sell-off, and that's because there is a rise in rates. So we were expecting that, but yeah, the sell-off was a little bit stronger than we thought it would be. But no, don't worry. This isn't the start of the bear market. We're completely fine. The bull is going to continue. And now let me show you why. So first, let's go over the fundamentals. So we take a look at the macro. It's still supportive of stocks going higher from here. Check out this chart of the financial conditions index. Conditions are still the loosest they've been all cycle. And when conditions are loose, that means that there's a lot of liquidity, which means there's a lot of money floating around in the economy. Whenever there's a lot of money floating around, that money is usually going to go towards stocks and push them higher, which is of course bullish. And if we take a look at earnings this quarter, so far they've been really strong. 41 companies have reported and 88% of them have beat expectations on earnings and 71% beat on expectations of revenues. So fundamentally, companies are doing great too. Now, if we move past the fundamentals and move on to indicators of sentiment and positioning, we can see right here in the latest Bank of America Fund Manager Survey for the month of October that most fund managers are still really bearish on the macro outlook for stocks. And they're holding large amounts of cash because of it. They're not invested. Now, this is a contrarian indicator because if these guys are so bearish, then that means there's a lot of money that can still go into stocks. They're underinvested. Bull markets don't die on people getting bearish. They die on excessive speculation. It's when people are all leveraged up and have no more money to put into the market, that's when things start to turn. And the bear market occurs as those people are unwinding all those positions because there's just constant selling for a long period of time. So that's why the more people that hate this bull market, the better it is for the bull market, because that means there's more potential fuel on the sidelines for stocks to go higher. If we look at advisor sentiment, bullishness has fallen to 56 from its high of 61 last month. Now, any reading above 60 for this type of thing should be a signal that a short-term correction is coming. Because if advisors are too bullish, like what I was talking about before, that means that all that's left is to sell, and there's probably a correction coming. Now, it would have been better if we saw this number drop lower with this recent sell-off, but it didn't. So that means that the volatility probably isn't over in the market. So just to recap, the fundamentals overall support the bull market going higher, and long-term sentiment and positioning indicators support the trend higher too. But the intermediate indicators say we may see another shakeout before we actually move higher. Now, if we move on to the technicals, we can see that the market is really oversold right now. This chart shows the percent of stocks trading above their 50-day moving averages. And you can see it's very few, which is why we're entering that oversold area. So at this point, we're unlikely to sell off below the recent lows that we just had without a significant push higher first. We can look at Bank of America's global breadth indicator and see that global equities have been extremely oversold too. So this indicator has actually hit a new buy signal. Now, there are some significant resistance levels coming up for the SPX. One of them is at the 2825 level, where the 100-day moving average of the index is coinciding with its long-term trend line. And then the other is at the 2875 level, which is right next to the 50-day moving average. So we got to watch and see what happens to price as it approaches these levels. They should provide some resistance. We're not out of the woods yet when it comes to volatility, but there are two major supporting factors that should push this bull higher into the end of the year. One of them is buybacks. So according to research from Goldman Sachs, companies in total are on track to repurchase more than 770 billion of their own stock this year. And that's compared to the next largest source of demand, which are ETFs, which last year bought only 347 billion in shares. So buybacks are a huge source of demand in this market. And right now there's a massive pool of recently repatriated corporate cash. It's just sitting on the sidelines. And these companies are waiting for earnings to be over because they can't buy around this time because then they get into legal issues with insider trading, so they don't want any of that. And they're also waiting for a dip to buy. So they've gotten their dip now, and once earnings season ends, they'll be buying again. We're also going into a period of the political cycle because it's a, midterm election year, that when you combine that with regular seasonality, it's historically been really strong for equities. So now let's show that the S&P has risen 20 of the last 22 times during the final 3 months of the year during midterm elections. And the average 6-month gain has been 12.45%. So things look pretty good going into the end of the year. So all in all, we're still bullish. We're still buying. I mean, of course, we're respecting our stops, but we're not getting scared out of the market just yet. Now, if you like this video and want to see more, make sure you subscribe to this channel and hit that bell for notifications of future videos. We publish about 3 a week, all market related. So subscribe, and I'll see you in the next video. Bye.